modern day warrior, mean stride. Today's Tom Sawyer, mean ride.
And welcome back to the show this morning. So just for the break, talking a little bit about the Fed and the Fed needing to buy bonds in order to basically monetize the debt. This is in order to allow the Treasury to issue the debt that it needs to cover the deficit. Now, we've had long discussions here on the show about the impact of running, $3, $4, $5, $6, $7 trillion deficits and the impact to economic growth. So you're talking about economic growth now well below 2% going forward. And if you'll remember, prior to the financial crisis, the economy was growing between 3 and 4%. After the financial crisis, we averaged around just a smidge over 2% growth. This stair step down will provide for economic growth of below 2%, which isn't enough to keep up with population growth. And that has a big function just to do with the amount of debt that we're issuing. We're not going to recover from debts and deficits of this magnitude simply because there's no willpower in Washington to do so. Despite the fact that fiscal conservatives run around raising their hands going, we've got to pay for the debt. There's really no desire to do that because spending money is the way to stay in office. But one of the problems that potentially we run into is an interest rate problem. And there's a lot of conversation right now about potentially how interest rates are going to spike up over the course of the next couple of years because of the amount of debt issuance. So interest rates very quickly are just a function of supply and demand. If I'm the Treasury, and so what happens with the Treasury is they need to print $1 trillion worth of bonds to cover the deficit. So they have 20 primary dealers that they work with. These are all the major banks around the world, JP Morgan, Goldman Sachs, et cetera. And they say, okay, hey, I've got $1 trillion worth of Treasury bonds here. I'm issuing out with a coupon of 2%. If there's no demand, if nobody says, hey, I'll buy those bonds, interest rates have to go up because what happens is the price of the bond, the Treasury, this is an auction market. So the Treasury says, here's the $2 trillion for sale, or here's the $1 trillion worth of bonds for sale at 2%. Who wants it? Nobody raises their hand. So that's at par. That's at 100 cents on the dollar. So the Treasury says, how about 99 cents? How about 98 cents? How about 97 cents? How about 95 cents? How about 90 cents? Whatever the number is, eventually there'll be a buyer stands up and goes, yeah, I'll do that because at 90 cents on the dollar, it's no longer a 2% coupon. It's a 3% coupon, whatever the yield works out to at that point. Don't worry about the math. It's just getting my point across is that the lower the price has to go because of no demand, the higher the effective yield. The yield, what we call our yield to maturity, is on that debt. If the Treasury comes to market and says, okay, I've got $1 trillion worth of bonds at 2%, and there's a massive, overwhelming demand for those bonds, the opposite happens. The price goes up and the yield goes down. Why is this important? The reason this is important is because this is one of the crises that the Fed may have to deal with. To issue all this debt, one of the big concerns is that this is going to lead to substantially higher interest rates because there's so much debt coming to market, nobody wants to buy the debt, and interest rates go up. Well, if interest rates go up, you have a whole lot of other problems that happen. Credit card rates go up, mortgage rates go up, auto rates go up, auto loan rates, they go up, the cost of living goes up. Everything is related back to that 10-year Treasury rate. So all of a sudden, interest payments go up everywhere. Well, households, by and large, 80-90% of them are already living paycheck to paycheck. It'll be worse after this crisis is over. And they already run about a $3,000 a year deficit in their household that all goes onto credit. So all of a sudden, if their interest payments go up by even a smidge, right, they have to go further into debt to sustain their lifestyle. If they don't get access to credit, well, you have a reduction in consumption, et cetera. So interest rates can't move up much before you start to seriously impact the economic growth rate of the economy, because so much of the economy is dependent upon the level of interest rates because we have so much debt. The more debt we have, so the rate of economic growth, the more dependence you have on low rates to fund that growth that you're getting. If interest rates go up, game over. So one of the things that the Fed may very well have to do is to do what they call capping rates. And this is very much how I think they get to the ability to buy an unlimited amount of treasuries from the government. They go, we're going to cap rates at 2%. So as yields start to rise, once you get to 2%, the Federal Reserve steps in and starts buying all the bonds required to keep that rate on the 10-year Treasury, for instance, at 2%. So you artificially manipulate the interest rate on 10-year treasuries to cap that rate from going higher. This gives them the ability to, and the excuse that they need in order to buy an unlimited amount of debt issuance. Now, that may be okay for the stock market, may be okay for Wall Street banks, not going to be okay for you. And the reason is simply this, is that at some point, the average American is going to wake up and go, hey, wait a second. Before the financial crisis, we were doing okay. After the financial crisis, we saw a vast majority of the wealth in the economy shift to the upper 10% of the economy. Now, after the pandemic, we've seen even more wealth shift to the upper class. So in other words, instead of it being the top 10% versus the bottom 90, it's now the top 5 versus the bottom 95. So economic prosperity is already set to deteriorate because of the virus and what we did with the shutdown. The amount of fiscal support provided to the financial markets is already exacerbating the gap between the poor and the wealthy, because people that have money to invest are capitalizing on the run in the stock market. The vast majority of Americans don't have any money invested. Well, Lance, everybody has a 401k plan. No, they don't. Statistics clearly show about only half of Americans have access to a 401k plan. And this is easy math. If 50% of small businesses make up 50% of employment, the majority of small businesses don't have 401k plans because they only have 2 or 3 employees, maybe 5. So they don't have 401k plans. So half of Americans don't even have access to a 401k plan. And of the half that do, only half of those actually contribute, because everybody else is living paycheck to paycheck. This is why the average balances of 401k plans for the majority of Americans, it's about $50,000. It's about 1 year's worth of income. So this deviation of economic prosperity, this wealth gap, is becoming much more problematic. And when the Fed's engaged in doing QE programs and these type of support programs, while on the surface, it's like, oh my gosh, thank goodness they're doing this. They're right. They're saving the economy. They're saving the markets. They're doing their thing. It sounds good on the surface, but the problem is these programs are a wealth transfer mechanism from the poor to the wealthy. And why is that? Well, who is it that owns businesses and operates businesses and those type of things, right? Who are the ones shielded from economic downturns? They're the business owners for the most part. Wealthy people generally generate their wealth. The bulk of the wealth that belongs to the wealthy comes from people that own businesses, right? They open up a business, they grow the business, they create wealth. The other 90% of the economy shops at those businesses. There is a relationship between the two, but the wealth travels uphill because I'm spending at those businesses, right? If I don't have any money and I'm living paycheck to paycheck, I still have to consume. So as I come out of this crisis, I may not have a job, but I still have to consume. I still have to go buy groceries. I still have to go buy, toilet paper. I've got to go buy paper towels. I still got to do those things. I've still got to pay my rent, got to pay my mortgage, got to pay my landlords. I've got to do all that. I may not have a job, but I'm going to take taxpayer dollars in terms of unemployment benefit, et cetera, and I'm going to pay those bills. Well, that cycle rolls uphill because the people that are collecting those recycled tax dollars are the people that own the businesses. So the problem is the more that we do of this, the weaker economic growth gets and the bigger the wealth gap gets. Not everything is good long-term. And the one thing that we have forgotten as fiscal conservatives is the importance of understanding the value of debt and the dangers of excess debt issuance. We've now moved into this idea that modern monetary theory is fine. We can just issue debt with no problems because we don't have inflation. There's a consequence, though. And that consequence is lower economic prosperity for the masses. Very quick, before we wrap up, the House is trying to pass this $3 trillion bill for funding. And if you are a landlord, this is going to be a terrible bill for landlords all around the country. If you're a person that owns 3 or 4 rental houses and you get your income from those houses, if this bill passes, you will be required to forego rent on your tenants. And in the future, if you take any money from the government from this bill to support your housing issue, you will have to agree to never do background checks. You cannot deny anybody any rent for any reason, race, sexuality, orientation. It doesn't matter what it is. You've got to allow that. Criminal records, doesn't matter. You've got to allow them. If they want to rent your house, you've got to let them. be careful what the government gives you and be careful what you take from the government, because this bill, you need to understand it. If you're a landlord, there is a huge problem, and it will devastate, small individual mom and pop landlords across this country for the benefit of Democratic agenda. That wraps up the show for the day. We'll be back tomorrow, of course, with Technical Trading Tuesday. So stick around. Be right back then. Get by the website. Our latest blog post is out this morning. Our newsletter as well. It's on the website. It's called Stuck in the Middle. What we're doing here with the markets and what to expect is all at the website, realinvestmentadvice.com, along with the link for our Great Reset webinar. It's on the website as well, realinvestmentadvice.com. Stick around, though, because Chris Salcedo is coming right up.
It's a rich man's world. It's a rich man's world.